Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Brian Joyce, Managing Director on Nasdaq's Market Intelligence Desk. We're going to take a look at the Nasdaq-100 in two different contexts, the equal weight and then cap-weighted index. Brian, it's great to see you as always. Welcome back to Trade Talks. Let's take a look at your first chart here. What are we looking at? What's the distinction between cap-weighted and equal weight?
So we know, most of the major indices out there are cap weighted. So the bigger the company, the greater the weighting of the performance of that individual stock on the overall index. The Dow Jones is an exception. It is a price weighted index, but NDX, S&P, Russell 2000, they're all cap weighted indices. And so we have, some pretty large stocks within the Nasdaq-100 specifically that have an outsized weighting on the index. So when we see that we're now on course, likely to have our first down year for the Nasdaq-100 since 2008 on a total return basis, will be our second year since 2002. It's only twice in 20 years has that been the case. But not all stocks underneath the hood of the index, so to speak, are performing as worse as, say, the broader index. So if you look here at the cap weighted index, the QQQ, then the letter E, that's the ETF over, it's a ratio over the QQQs. We can see that this index actually bottomed back in December of 21 and has since been trading higher. So the relative outperformance on individual stocks has been greater than what we've been seeing in the big overall index that's weighted to those larger cap companies, some of them multi-trillion-dollar companies.
Right. So Brian, for example, we know Meta, Facebook, right, has been under significant pressure. It's down over 60% on the year. Of course, what we've seen in Tesla, because those two names have such massive weighting within the index, it's certainly going to influence performance more so than what you're seeing in the equal weight index, in the equal weight QQQ's ETF. So
Correct. So if you're an active portfolio manager and you're not simply just tracking exactly the index itself, but you're trying to outperform the index, there are certainly plenty of individual names within the index that you could, weight differently in your portfolio.
Right. Let's take a look at the Nasdaq-100 just in general for a performance review here.
Yeah, so we could see, we highlighted on Thursday this price gap that was created back in early November. We said that was the risk that we could see the stock dipping back into, and that would be where we want to reassess the risk profile here going forward. So 11,012 is the bottom of that range. I'd call it a near-term, short-term support level. That's going to be the key level to look to going forward. We can see the index is trading well below its 200-day average, and it's actually been trading below this moving average since late March, so almost 9 full months. Bloomberg ran an interesting stat today. It's the longest number of consecutive days, which is currently 178, where the index is trading below its 200-day moving average. Haven't seen that streak since 2002. When we look here now to the weekly period chart, you can see longer term where we're not far from retesting those lows made back in October, which was the significant low made back in September of 2020. So that's going to be a key level to look to on a longer term basis, which is down about 10,677. So that's a key level. I think that weekly close that we made back in October for the Nasdaq-100.
Yeah, Brian, anything else worthy on the charts that you're taking a look at as we head into 2023?
Yeah, I mean, we were discussing corporate earnings last week, so we'll be interested to see, what the street does, the expectations of what the Fed's going to do. Will they keep rates as high as they are now, around 5%? I think maybe we have a couple more hikes left to go. That'll take us up to about 5%, maybe 5.25%. The Fed's forecasting is going to keep rates up to that level over the next 12 months. That's where the divergence is with the marketplace, where they think the Fed will start cutting by the late summer. So we'll wait and see how that shakes out and how its impacts on corporate earnings, whether or not the Fed is more aggressive than what the market is anticipating. On the chart level, I think what's interesting, we've seen a pretty big pullback in the dollar. We've seen a pullback in rates. That's typically good for overseas emerging market stocks. So if we see, it's been roughly a 12-year trend where emerging markets have underperformed developed markets, particularly the S&P 500. So, I'm wondering there if that's something for 2023 to look at. If the Fed at some point, does start to slow down, does become less hawkish, will that take some pressure off of the dollar, which at one point this year had its biggest annual gain ever on record? And if the dollar does continue to weaken or really just hold around these levels and doesn't continue to strengthen much further, then I think that potentially sets up an environment that could benefit emerging market stocks. at least on a relative basis.
Got it. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.